Joining me now is Harvey Flax. He's the Director of U.S. Interest Rates Futures Business Development for Intercontinental Exchange. Harvey, welcome to the show.
Good morning, Ashley. Thanks for having me.
So what are the futures markets indicating about this Fed decision today?
So the futures markets are pricing in a near 100% probability that the Fed will lower their monetary policy rate, Fed funds, by 25 basis points this afternoon. Again, establishing a new target rate of 3.75 to 4%.
All right, what is the market view on shorter-term Fed policy?
So in the short term, the markets are pricing in approximately an 85% chance that the Fed will lower rates at their next meeting in December, and a similar 85% chance that the Fed will lower interest rates at its March meeting at the end of Q1.
All right, and is the government shutdown impacting the Fed's decision-making process? Do you think it has any, bearing on what that decision will be today?
Currently, no. The Fed sources economic data from many places. Yes, of course, they are missing the reports from the government, from the BLS, the marquee reports around inflation and labor, but they do source reports from third-party vendors, and they have their own internal reporting. Recently, about a week or so back, Chair Powell did reflect on this and said we're okay now. However, if the process continues, in other words, the government shutdown continues, then the loss of that data can impact future Fed decisions.
The last few Fed meetings have lacked consensus. What have been the drivers for that?
Sure. I guess the dissenting votes indicate a difference of opinion with the policymakers around how to, manage the challenges of their dual mandate. You have rising inflation and a weakening labor market. Now, on background, the Fed indicated earlier in the year that they would have lowered interest rates if it wasn't for their concerns about the tariffs' impact on inflation. Come to the July meeting, you had 10 policymakers basically voting to keep rates on hold as they believe the concerns around, or the rising inflation was more important than, so to speak, than anything to do with labor at that point in time. It was a steady state labor market. You did have two members dissenting. They voted to lower rates by 25 basis points. Their view that any impact from the tariffs on inflation would be transitory, and they wanted to get the easing cycle going, so just to help bolster the labor market. Come full circle, we hit the September meeting, and the flip script completely. Though inflation continued to rise, you had economic data indicating a weakening labor market. The Fed cut rates for the first time, 25 basis points this year. And you had 11 members voting for that 25 basis point rate cut. You did have one dissenting member who wanted a more aggressive 50 basis point rate cut.
And I understand that Fed Chair Jerome Powell is going to be making remarks after this decision, today at 2:30 p.m. Eastern. What are you expecting from his comments?
Sure. Myself, certainly consensus among economists. They believe he will address the current government shutdown, but in the context of the missing data reports and how it may or may not be impacting their monetary policy decisions. They also are expecting a 25 basis point cut, so they expect the chairman to opine on that. Again, what is the driver for that? And obviously they believe that this is all related to the weakening labor market. In addition, they believe that Chair Powell will continue with the boilerplate pronouncements that every meeting is live, that they are completely data dependent, and they are fully focused on managing their dual mandate, in other words, a 2% inflation target and a fully employed United States economy.
And what are the implications of the Fed monetary policy rate for the mortgage rates and the housing market?
So the Fed monetary policy rate, Fed funds, is the anchor rate for the United States. It governs all short-term lending. It's the base rate. Now, mortgage rates, they are higher rated products. They are more or less influenced by the U.S. Treasury yield curve. Most mortgages in this United States is governed by that 5 to 10 year sector of the yield curve. And that's, Treasury yields are influenced by many factors. The Fed is not, the Fed's monetary policy rate does influence it a little bit, but in this particular cycle, we have a rapidly easing Fed. There will be some carryover. The ICE rate lock mortgage future is indicating that through the April 2026 contract, that you will see mortgage interest rates drop from where they are now to about 6%.
All right, Harvey Flax from Intercontinental Exchange, thank you so much for joining us at the New York Stock Exchange.
Thank you, Ashley. It was great to be here.